So, markets opened just moments ago, and things are not looking so bad. I mean, literally, it's been sort of just a minute of the markets being open. Regional banks really took a hit yesterday, lost a lot of value, with investors kind of a little concerned as to whether or not what they saw that happened at the Silicon Valley branch or bank rather in Signature Bank, whether or not that sees some spillover into some of these other regional banks. But there's a lot of questions as to whether or not we'll see a recovery as the day unfolds. So we'll be watching the stock market for you. You know who can speak to that? The person coming up next. Joining us now with more on how the markets are doing in the wake of the bank failures is Joe Saluzzi. He's a partner and co-founder of Themis Trading LLC brokerage firm based in New Jersey. Hey, it's good to see you again. So, hey, so yesterday, regional banks, lost a lot of value. What's your expectation for today?
The point you just made about them not having a chief risk officer is a really important point. This is, a risk management issue at a bank, which was a different type of bank. So I think most of the depositors shouldn't be worried if you're in a regular, community style bank. But this bank itself had a lot of business owners, and what they were looking for was the traditional, a lot of people getting caught in this yield trap. They were trying to earn more on the deposit money that they had. So it caused a problem there. There were certainly some problems at some other banks, but I don't think this is a 2008 style contagion. And I've been around long enough. I've been through that, and that was bad. It was really bad. Now, with that said, you still have to be careful, and you got to watch. You have to watch to see if anything big happens, anything at some of the bigger banks comes out. But as of now, the good thing was that the Fed and the government did come in very quickly over the weekend with the program to backstop some of these banks by saying, hey, if you need, you don't have to sell these securities. Basically, the problem was that Silicon Valley had to sell securities. We'll give you a loan in the meantime. So to your question, I think we've stabilized somewhat.
Joe, Facebook parent company Meta just announced they will cut 10,000 jobs and will close 5,000 open roles. What does this say about where the tech sector is?
That's more of the same what we've been seeing in these big tech stocks. They've been laying off, consistently since last year. And, look at the tech sector last year, we were down over 30% in NASDAQ. So these companies, what it looks like was they got too big. During the pandemic, a lot of them, there was issues going on there, and they realized that they need to trim staff, they need to cut expenses. And to be honest, this is a good management decision. They need to control their costs. This is what public companies do. These are big, giant behemoths. So from a management perspective, it's prudent. From an employee perspective, no, it stinks, right? Nobody wants to get laid off, but a lot of these companies tend to overhire and then overfire, and that's a traditional Wall Street thing as well, too. They overhire and overfire, but in this situation, it's more of what we've seen over the last year, and they're going to continue to do this until they get those expenses in line.
Joe, does it matter? We always kind of like to talk about tech sector layoffs, but as we've said before, the tech sector is not a massive employer at all. But it's kind of interesting to talk about. Does it matter more what departments are losing individuals versus the number of layoffs, say for Meta?
I guess you could look at the style, the type of income that we're looking at. Are these the higher paying jobs that are being laid off? Will that have a bigger effect, let's just say, in the San Francisco real estate market, which people have seen?
Well, Joe, what I mean is, can that give us a bigger indication as to what's going on in the economy? For example, if they're laying off in advertising, but they're not laying off in product development, does that give us a sense of where they think the economy is going?
I'm not sure. I really can't speak to that. I think it's, those companies are, like you said, they're managed differently. So I'm not quite sure on that one.
Okay. Joe, are investors fearful of more interest rate hikes next week as the Federal Open Market Committee meets?
They are, and actually going into this weekend, prior to the bank collapse from last week, people were anticipating a 50 basis point hike again, which really, after the Fed's, the Chair Powell spoke before Congress, that scared a lot of folks because that put that back on the table. And we've been, the problem here, and the reason why we're having these problems in the banks is we've really had reckless monetary and fiscal policy, if you ask me, over the last couple of years. In that, I mean, they kept rates down too long and they rose way too fast. So the market gets shocked, and you can't just shock the market like that. It needs to anticipate it and build it in. And we haven't, we've gone just the opposite. We've gone into these panic style situations where we throw $3 trillion at it and then we keep rates too low. And now we've raised them too fast. So to your question, I think they're now anticipating more of a 25 basis point hike. And some people are actually saying by the end of the year, you might start to see some interest rate cuts. So, the financial problems and a financial bank problem, that will cause the Fed to take another look at things before they start raising that rapidly again.
All right, so much going on. Joe Saluzzi, thanks for breaking it down.
Thanks for having me, guys.